Should you buy property now or wait? It's a question that's constantly being asked in the midst of the continual deluge of fear-driven negative news and the crippling uncertainty that's being peddled by the mainstream media. And it feels like a day doesn't go by where the nightly news, newspaper headlines, and our social media feeds aren't paralysing us like rabbits in the spotlight as we're constantly reminded of doomsday predictions on all things property. There's the relentless, unfounded hysteria about rising interest rates, the mortgage cliff, runaway inflation, falling property values, and the always imminent but never quite eventuating property crash, along with a whole bunch of geopolitical tensions right around the world. So you can always find an excuse why now is never the right time to buy property. But is the fiction supported by the facts? Should you buy now or wait? Well, to add a balanced perspective to this frequently asked question, we're joined by PK, who's an active property investor and educator, as the Managing Director of Consulting by PK. Let's start by asking that age-old question. Is it time in the market or timing the market which is more important?
It's such a common question. And I remember like maybe 7-8 years ago when I used to hear podcasts, not necessarily this one, but some others, and every single property educator, buyer's agent, anyone who was trying to sell you something will always answer this question the same way, that it's not timing the market that matters, but it's rather time in the market. And initially I used to think, yeah, that it makes sense, right? Because we have to hold these properties over the long term. The longer we hold them, the more dividends we reap, right? The more benefit we get. But then as I listened to more and more podcasts and kind of started building my own portfolio, I started to realize that that's actually not necessarily true. And it might be self-serving for people like me who are trying to sell stuff to say it's all about time in the market, not timing the market. Because clearly, like, let's say you bought in May last year, 2022 in Sydney, or let's say Brisbane or Melbourne to some extent, you'd have lost money. Now, of course, there's always markets within markets, but let's just say on average, you would have lost money. So where's that adage gone? Time in the market. No, you rather time the market, right? No, of course, it's really difficult to time the market perfectly. No one can really have a crystal ball and say the 29th of August is going to be the bottom of the Australian property market, or the top for that matter. But my philosophy, to be clear, is that both are equally important. Time in the market is very, very important. Flipping property in Australia, look, there might be many people more intelligent than me. They can do it. But for me, it's a mug's game. The transaction costs in Australia are so hard that to consistently, predictably make money by flipping properties, at least I can't do it, right? I'll be honest. So, there's difficult. You need time in the market, at least 7 years, if not more. Right? But timing the market is just as important, right? And of course, we can't get it down to the second, the hour, the day, maybe not even the month, but we can get that pretty accurate, not at the national level, but at a suburb level. Okay, so this is the difference. There's always markets that are rising at the same time, those that are plateauing at the same time that are dropping. So I'll give you an example right now. Obviously Sydney, you can almost pick any market, it's going down within Sydney. You go to Perth and you've got locations like Marewa, you've got locations like even like lower socioeconomic areas like Seville Grove that have gone up $50,000 literally in the last 2 months, according to CoreLogic. You've got places like Rockingham, which is very popular amongst a lot of investors, that are rising at the moment. And we can predict these things based on data. It's not perfect. We can't tell you that's going to go up by 13.75%, but we can say that this suburb will dramatically outperform this other suburb at this moment in time based on data. So to conclude, both are important. If we take some very high level statistics, we've never had a downturn in Australia property that has lasted for more than 6 quarters. The average downturn has lasted for about 3 quarters. The 6 quarters one was starting in 2017. So if we say that this current downturn is bigger than the last one, which according to the stats, it's already breached it, so it is bigger, and let's say it's a little bit more than 6 quarters, then we'd see the national property market bottom around September, October of this year, 2023. But of course, there's markets that are rising right now. So it's hard to say what the bottom is because we can't buy Australia, you can only buy one suburb.
Totally agree. And I think the real danger in any discussion around this is the whole idea of a property market and relying on median prices to make those decisions, PK. We won't dive into that right now, but it's a misnomer right there, because every property in every street in every area is generally different from every other one of the 11 million properties around the country. So making decisions based on medians and broad areas, I think, is fraught with danger. But in the context of what you're saying there, the combination of timing the market and timing the market, if you can combine those two, then you're minimising your risk. So I want to now look at the sort of negative side of the overarching question we're looking at here and ask you, when's it a good idea not to buy property?
Yeah, I don't think this question really ever gets asked or answered properly, so I'll try my best, Bushy. I don't think it's honestly a good idea to buy property if you cannot afford to have interest rates. And by interest rates, I mean your average variable lending rate from your bank, not the official cash rate, the lending rate at 6 or 7%. That's the long-term average. So I remember like 2 years ago when we were emergency quantitative easing settings, I was still advising my clients, guys, this is hugely positive cash flow, but make sure you do your household budgeting, because if lending rates ever go to 7%, it was wildly unforeseen 2 years ago, but we're almost there now, right? You need to be able to hold these properties. You should never have to sell it. You might want to sell a property. You should never have to sell it due to cash flow reasons. So if you can't afford it at that higher interest rate, it might not be a good idea to buy it in the first place. And for a lot of people, that rules out Sydney and Melbourne property altogether, because average property costs about 20 grand to hold in those areas. So that's the first reason. The second reason why you may not want to buy a property right now is that you only want to buy in your backyard or only want to buy in a particular location. Like I live on the Gold Coast. Let's say my mindset was I only want to buy in Queensland, I only want to buy in the Gold Coast, I only want to buy in Brisbane. Right now in the property market, there's not too many properties that are rising in the Gold Coast. There's not too many properties that are rising or suburbs that are rising in Brisbane. So if I really just wanted to buy in Brisbane for sentimental reasons, or let's say because I'm already capped out with land tax on every other single state and territory, then it might be prudent for me to say, okay, well, let me just assess the market from the sidelines, 6 months, 12 months. I can't time the bottom of the market perfectly anyway. So if I start to see some green shoots in the ground, that might be my opportunity. So I don't lose money in the first 6 months. We always want to make money in the short term so that future growth compounds on that initial growth. That's terribly important in terms of property equity mathematics. So those are my two reasons of why you probably shouldn't buy property right now.